If you hold a rental property in an LLC and are thinking about selling it, in this video, I am going to tell you what you need to know from a tax perspective to keep you in the good graces of the IRS. When you own rental real estate and you hold it inside of an LLC, what's going to be really important when you get ready to sell it is to make sure that you get a copy of your final closing statement that actually shows you the total sales price. Sometimes what you started out to sell the property with may actually change, but when you're preparing for your taxes, your tax person is going to need your actual closing statement that shows the final sales price and all the other credits that you may have received through the transaction through escrow. So it's important that we get the sales price correctly. Even more important is that you get your cost basis correct. And when I say cost basis, this can be really confusing to a lot of people. When you originally purchased that property, you purchased it maybe for $200,000, $100,000. But what's going to be important is to go back and get your original purchase statement that you actually use when you close escrow on the original purchase of the property. Why do I say that to you? Because on that statement is going to have all the total acquisition costs of your particular property. Perhaps you paid $200,000, but with all the costs involved, maybe it was $210,000. And this is the time that we really want to make sure we're capturing the total acquisition cost when you originally purchased that property, because it's going to become important when we calculate your gain on sale. When you are calculating your costs, I want you to think about all the money that you put into that property over time. Did you put on a new roof? Did you do new landscaping? Did you add appliances? What other costs did you incur when you acquired that property? If you incur those costs and you didn't write those costs off on your taxes anywhere, now's the time to aggregate all those costs together. All of those costs become the actual cost of acquiring your property. So it's the original purchase price plus all the costs to close the deal plus any improvements you did along the way. You want to make sure you capture 100% of that. But here's the other thing that is going to be critically important is your actual cost basis, different from your acquisition cost. So acquisition cost is what you paid for the property plus all the improvements you added to it. But now I want to talk about cost basis. Cost basis is different. Cost basis is the amount of the property that you actually paid for less all the depreciation that you took over time. When you own rental property, remember you can depreciate the amount of the building cost, not the land. If you have depreciated the cost of that property, and let's go back to our example of $200,000, and let's say out of that $200,000, we're going to allocate $150 to building and $50,000 to land. The $150 that you allocated to building, you would have depreciated. Maybe now you've taken $50,000 worth of depreciation. You started off at $150, but with that $50,000 worth of depreciation, your cost basis in the land is only $100,000. That's really important because when we are looking at calculating your gain on sale, how much you're actually going to have to pay taxes on, is very important that we have all the elements. We need to have the sales price, we need to have the acquisition cost, and we need to have the actual cost basis on the day that you sell the property, because there's this thing called depreciation recapture. And what does depreciation recapture mean? Depreciation recapture means going back to our example where you acquired a property for $200,000, and remember we said $50,000 went to depreciation. That $50,000 now is going to have to be recaptured. And what that really means is when we calculate your gain on sale, the portion of that depreciation is going to get taxed at ordinary income tax rates. And you might be thinking, hold on, Carla, this is an investment property. Don't I get capital gains tax treatment? Yes, you do, but only on a portion. When you sell investment property, your tax treatment is going to be a capital asset for which you're going to get capital gains tax, whether it's federal capital gains tax plus state capital gains tax. But that portion that is depreciation recapture, in our example, that $50,000, that amount is going to be taxed at your ordinary income tax rates. And this is what really gets my investors in a lot of trouble, because typically when you are trying to figure out how much your gain on sale is going to be and how much your taxes are going to be, you're only looking at the capital gains rates. And you're probably looking at the 20% capital gain rate. However, you gotta factor in the actual depreciation recapture that is gonna get hit with ordinary income taxes. And so in an example where we actually have a property that we purchased for $200,000, and let's say we sold that property for $300,000. If you purchased it for $200,000 and you sold it for $300,000 and you actually depreciated that $50,000, your cost basis is only $150,000. Your gain on sale is going to be $150,000. And at a 20% tax bracket, that's going to be a $30,000 capital gain. But hold on a moment, it won't be, because of that depreciation recapture that is going to get taxed at ordinary income tax rates, which means your gain on sale and the taxes are going to be higher than what you thought. Instead of paying $30,000, you're probably going to be somewhere around the $40,000 mark just for federal income tax purposes, not even factoring in the state income taxes. So what's really important when you are selling real estate inside of an LLC, that you recognize that you need to have the original purchase price, the original sales price, the depreciation that has been calculated, your cost basis, so you can actually calculate your taxes properly, and that you're not going to get that shock when your tax professional tells you exactly how much you're going to have to pay in income taxes. It's important to do all of that due diligence up front to come up with your calculations so that you can negotiate your sales price properly, so you can get the right amount of cash in your pocket when you're thinking about selling your investment property in an LLC. And here's the other thing. When you're doing a sale of rental property inside of an LLC, it's going to flow through to your personal income tax return, meaning you're actually going to pay the tax at the personal income tax level unless your state has a separate tax on LLCs. So just really important for you to understand all the factors. So if you enjoyed this video, I want you to like, comment, and subscribe. I can't wait to see you on the next video.